Welcome to the Money Mastermind Show. Let's talk money.
And welcome to the Money Mastermind Show. For most people, paying off your mortgage is something that will happen just around retirement age or so. But if you want to, you can pay off your mortgage earlier. But should you? How are you going to do it? Well, this week we're going to look into that and whether or not you should pay off your mortgage earlier. Joining us is Cornell Schraber of BuildWealthCanada.ca. Welcome to our show, Cornell.
Thanks for having me, Glenn.
Thanks for being here. And the rest of the Money Mastermind Show, of course, is Kyle Prevost of YoungandThrifty.ca, Miranda Marquette of Planting Money Seeds, Peter Anderson of Bible Money Matters, and Tom Drake of the Canadian Finance Blog. I'm Glenn Craig of Free From Broke. So before we start, if you're out there and you're watching and you have any questions about paying off your mortgage earlier, head over to our event page. We have a Q&A app there, and you can put your question in there, and we'd love to answer it. So, as I mentioned in the intro, for most people, your mortgage is something that hangs over you for decades. It's one of the biggest debts you're going to take on in your life. But it's just something you deal with. Having a mortgage has its benefits, puts you into a home, but it's also something you're going to be paying for a long time, as well as you're going to be paying a ton of interest on that. Is there a better way? So, Cornell, you have an interesting story because you did pay off your mortgage early, and not just like 5 or 10 years early, but way earlier than most people do.
It was at when basically ended up being in 6 years, we ended up paying it off. So when I was 29, we officially, just after turning 29, our mortgage was officially paid off. We actually had all the money ready to go when I was 28, but then, because of the term and all that and all the paperwork and everything involved to finally close off the mortgage, there's some time there. So technically, we were, I guess we could say mortgage free because we had all the money, everything at 28. But 29 is kind of what I say because I actually have the paper to back it up in case someone ever questions it.
I know there's so much paperwork to get a mortgage, and I get that, but why is it difficult to pay off a mortgage? Like, if you send in that final check, they should just say, okay, that's great. Here you go.
Yeah. Well, like in our case, the mortgage was ending. Like our contract, the mortgage was ending right after my 29th birthday. So we thought, okay, you know what? Instead of kind of going through this whole process of canceling it and the fees and all that, let's just wait and just let the contract close. That way, it'll be a nice clean thing, right? Because typically, when your mortgage term is over, let's say it's 5 years generally here. After that, before that time comes, you start talking to your bank and you start talking about, okay, now let's take on extend the mortgage now, right? And you get into that whole conversation. So in our case, it was, okay, well, our mortgage is over, and no, we're not renewing because we're done. Here's all your money.
And I think that's an important distinction to make, though, with Canada, is that you do have these shorter terms where you have to renew your contract more regularly. In the United States, the standard is often 30 years.
Oh, like the actual term is 30 years or amortization?
Yeah. No, the actual term, like you.
Oh, really?
Yeah, that's the average usually.
Yeah, that's the average. I mean, some people do 15, but most people do 30 years.
Interesting. Yeah, like in our case, we did a 5-year term, and then after that we thought, oh well, we're almost done our mortgage, so let's just take a 1-year term. So the one that kind of the last one we had was just a 1-year term mortgage actually. So that's interesting. I didn't know it was that much longer in the U.S.
Yeah, they lock it in for that whole time usually.
Mm-hmm.
What is the general term for people to hold on to a mortgage in Canada? I mean, do they normally hold it for about 30 years anyway, and they just keep renewing it?
Yeah, like generally, because there's amortization, which is sort of how long it's spread out for, right? Which is so the amortization will be, let's say, 30 years is what. I mean, there's some flexibility there, right? You can make it longer or shorter, depending on what you want. Obviously, the longer you make it, the smaller your monthly payments are going to be. but then the more interest you're going to be paying throughout the life of the mortgage, right? So it's up to you kind of how you want to do it. Like 30 years kind of was a sort of a common one. At 25, I know it's been used a fair bit as well. But then you would take the term would be usually, like by default, they'll say 5 years, right? So every 5 years you would kind of go back and you'd meet with the bank or the mortgage broker or whoever, and we'd say, okay, the rates maybe have changed now. Maybe the terms will be a little bit different now. How does your situation look, right? And then you sort of renew the contract, right? So in our case, like I said, I forgot what we amortized it. I think it was 25 or 30 years, but then our term was, the first one was 5 years, and then we did 1 year after that.
Gotcha. So you would still have it for a comparable time as somebody in the United States. It's just
Sure.
that you go through this negotiation every 5 years or so.
Exactly. Yeah. Like it's still, you're still talking 30 years, and when you're doing all your math, it's just, but the contract, it gets kind of refreshed every 5 years generally, or, depending what you agree to with the bank.
So even though you finished after this, it sounds like 5 or 6 years, that's still, that's
It's
not
so
the
good.
norm at all. That's
Oh, no. Like the
shorter
norm
than-
is still like 30 years or, or whatever the latest stats show. But yeah, like generally people don't pay off their mortgage in 6 years. No. Yeah.
So tell us, how did you do it? How were you able to do something in 6 years that's usually taking most people about 30?
Sure. Yeah. So there were a couple things that we did. I kind of thought about this and sort of narrowed it down to three big kind of components. So the first component was kind of, I call it, where am I bleeding financially? And this is basically just taking a look at where you're spending your money and seeing if there are any areas that where you're spending a fair bit of money in, but it's not really increasing your standard of living or your happiness all that much. All right. So a kind of an example I like is with a transportation, with a car. Cars vary so much in price. You can get a car for 10 grand. You can get a car for 3 grand. You can get a car for 40 grand, right? Or even more so. So that's kind of one of the questions, you kind of have to ask yourself is, okay, if I'm buying a car for, let's say, 30 grand, or I could be buying a car for 10 grand, is that 30 grand car giving me 3 times more happiness? Is it increasing my standard of living by 3 times? Because it's costing 3 times as much. So hopefully it's giving that payoff. And, and generally if you talk to people, they're going to say no, like the more expensive car has some cool features, but I'm not 3 times happier than I would be with a $10,000 car. I'm like 5% happier or whatever, right? So, so you kind of, so you look at those things, and same with housing too, right? I mean, okay, so I paid all this extra money for an extra bedroom or for a kitchen with granite countertops versus standard countertops. Is this, how much happiness is this generating for me, right? And so when you look at things that way, you kind of see, okay, you know what? It's so easy to spend a lot of money. And a lot of times it really doesn't add to your happiness and your standard of living. And if you look at all the signs behind it, I mean, it backs it up quite nicely when you look at all these sort of luxurious things. There really isn't, the happiness they generate is very short term. It's not very sustainable. So that was kind of the first thing that we did is, we didn't have a crazy expensive car. We didn't go out and buy this extremely expensive house, even though we could have gotten a much bigger house than what we ended up getting. But we got a semi. It was something that was reasonable, and we didn't go to the bank and say, hey, what's the biggest house we can get based, that we can qualify for, and let's get that one, right? We just said, no, what's a reasonable house we can get that we can pay off and that we'd still be happy with. So those were kind of the big things, right? The transportation and housing. But then there's the kind of the smaller things too, which are kind of the silent killers as well. So one of them is eating out, for example, right? I mean, it's a lot of fun to go out and go and try out new restaurants and things like that. And we definitely did that. It's not like we didn't enjoy ourselves, but at the same time, you don't want it to get out of hand, because the cost can really escalate if you're always going out to eat. And then you're also kind of getting fatter at the same time. So there's sort of a double negative thing going on there. So you kind of want to keep track of all those smaller things as well, like shopping and going out to eat. So that's kind of what we did. But I really didn't want to, because I work quite a bit in my job, and so I didn't want to go home after being in front of the computer all day and start looking at receipts and entering receipts in a budget and counting them up and all that stuff. I mean, that's just there's a million things I'd rather be doing. So I found a way basically to automate sort of that whole process. So I started using Mint.com pretty extensively. I'm not really affiliated with them at all right now or anything like that, but it's just something that I really enjoy doing and I still use today. Because basically they download all your transactions from all your accounts. And I'm sure all you guys have all heard of Mint and know what it's about. But for some of the listeners that don't, it basically just takes all your accounts, puts them in one spot, and it automatically categorizes them into different categories. So you can really quickly and easily see without doing any data entry. So what are we doing in terms of going out to eat? Are we overspending? And you can set certain budgets, like send me an email or flag it if I'm spending more than X amount on going out to eat every week or every month. And so when if you start going a bit overboard, you've got the system that automatically warns you saying, hold on, you're spending a lot on going out to eat lately. Maybe you should slow it down. Eventually you'll find it anyway because your pants stop fitting, right? But
I think, to be fair, it depends on where you're going out to eat also.
That's true. So
it's interesting, Cornell, because what you're describing here is like the exact opposite of what most people in North America do, right? They go to the bank, they say, how much house can I get? They buy the maximum house, the house that looks the most like the HGTV house. Then they say,
right,
well, what will up my status amongst my peers? Well, a fancy car will. So let's throw down, like you say, 30, 40 grand on a vehicle. If you come from Tom's neck of the woods, you then put a lift kit on that vehicle and hang various accessories off the back of it and hope that too reflects your status. So it's what you did was essentially the anti-North American in some ways.
A most rational approach, I have to say.
Yeah, I mean, it's a difference between acting rich and actually working to be rich, like Thomas Stanley says. And you talk a lot about living below your means and not necessarily having to have the best of everything, but knowing what you need and what your family needs. And when you're thinking about paying off your house, does it kind of go back to the beginning point of actually sitting down and figuring out how much of your take-home pay you actually want to be spending on a mortgage, and then kind of working from there?
Yeah, so like in our case, I remember we want to have a job that was, or a house relatively close to where we're working, right? So we looked at that area. We looked at, okay, what would be a reasonable commute? What are houses in that area? And I mean, there's such a big price range, right? I mean, there's, because we got a semi, which is a lot cheaper than a detached home, right? We could have gotten a condo, which would be even cheaper, but then there's sort of the condo fees we'd have to pay, right? So yeah, so we kind of did that analysis to see, well, what's a reasonable amount to pay? And right away, I really want to be mortgage free right from the, as soon as possible. So at that point, I also didn't want to have a house. I mean, if I went out and got a $500,000 house, I mean, that's going to take a long time to pay off. I mean, especially if you're straight out of school, right? Even if you do have a high enough paying job where the bank will lend you that money, it's really, it's a bit unmotivating because you're like, I'm never going to pay this off. This is ridiculous. Like if you're in Toronto and you buy $1 million house and you're in your 30s, I mean, that's, it's kind of like you want to almost throw in the towel right there, right? It doesn't really seem like you could ever achieve that. So for sure, yeah, we kind of did that analysis to see what is an actual reasonable place that we can get where in a reasonable amount of time we could actually be mortgage free and not see that giant amount leave our account every single month. So
what did you consider reasonable at the beginning, Cornell? Because that term reasonable can widely vary.
What I consider like a reasonable house?
Reasonable amount of time. So when you sat down and you looked at it, what did you consider reasonable amortization?
You know what? At that time, I didn't really know. Because we kind of, I did something wrong, and that is that right out of university, when we got our first jobs, we bought a house right away. We definitely should have rented first. That was a mistake that I did. But just to, to get a feel for the area, find out if we actually want to live there. But we got a house right away. So I didn't really know at that point because I was starting a new job at a university. I didn't really know exactly how all the numbers were going to work. I didn't really have much of a benchmark. Well, how much are groceries going to be? How much are utilities going to be, right? I didn't, I kind of had a ballpark, but it wasn't, it wasn't as exact as it could be because I was new to all this still, right? I was a fresh grad, right? So I didn't really have, I couldn't be as scientific about it as I could right now, for example. So not sure if that answered your question.
One aspect of what you were saying is that it was the house that you chose and the other items that you decided to spend on. If I'm hearing correctly, location was also a factor in what you chose.
Yeah, for sure. I mean, obviously if like in our case, I worked in Mississauga, it's a really expensive place to own a home. So we ended up living in a city that was adjacent to that one, which meant a bit of a longer commute, but a substantially lower mortgage, right? So for sure, we definitely considered that as well. Yeah. So the area was important. So that was kind of the other big lesson learned was really study your commute, because just because Google Maps says that it's a 20-minute drive, during rush hour, it could be a 45-minute drive. And that's what it ended up being for me. And that was kind of another mistake that I did is miscalculating the commute. I just kind of trusted my real estate agent when I said, hey, how long would it take me to get to work? And she just said, 20 minutes. And then you factor in snowstorms and collisions and and rush hour, right? And so that was kind of another. So yeah, the location is really, really important for sure. There's some other things that we did that let us get there. And I can get to those too if you want.
Sure. I mean, I want to hear all about it. But I think that just location itself, that's a huge factor. I mean, I'm from the New York City area, and just to be here, your costs are going to be so much more than you would in other parts of the country. I mean,
sure.
You talk about a $500,000 home, that is not so outrageous by me. And I'm not saying that to brag in any way, shape, or form.
It's like Glenn's got a $500,000 home.
It's all relative, right, Glenn? It's all relative.
It is. But that's also the cost of living here in this area with taxes and with the home. That's just what your prices are going to be. Whereas, like, if we hear about other parts of the country where that same amount of money, you're buying almost a palatial estate. So that's just an interesting aspect that you talked about. Although it does sound, though, that if you had to do it again, you might have chosen a different town that maybe costs more just for the commute itself.
Yeah, in retrospect, what we would have actually done is right out of university, we would have rented first. So found a place where, we could get a reasonable place and just to try out that area to see whether we want to actually live there, if we want to live in that city. So, I mean, in our case, we moved to a city and we got robbed twice in 1 year because the city wasn't the safest of cities, right? So
what you pay for.
Yeah, so what's our car? And it wasn't like we were in some sketchy neighborhood either. It was just that city just had a higher crime rate, and so we had our car broken into once. We had someone trying to break into our house. Unfortunately, the alarm scared them off. But so that's kind of another thing. Whereas if we rented, we probably would have maybe we wouldn't have had our apartment broken into. Maybe we would have. I don't know. But you kind of learn things living in the city. What are the good areas? What are the bad? Is this a place we actually want to live? Like in our case, we ended up moving by the Toronto area, but after a year we realized, we actually like it back in the Kitchener-Waterloo area where my wife and I are both from. Our family's there, our friends are there. That was just more a place that we enjoyed. That just a place where we wanted to live and raise a family eventually as well. And so we ended up moving and so that wasn't the most efficient thing to do in terms of money, because obviously there's high transaction costs for buying for selling a home. And so ideally we should have rented, seeing if it's right for us, and then made a good decision whether we should buy a home in that area or not. So that's kind of another thing, is not to just rush in and buy a house as soon as possible, because renting is always a waste of money. There's and on my podcast actually I did a whole session of where I talked about my experience and kind of what I learned from it and what to do and not to do and what to consider when you're deciding whether to rent or buy, because there's a lot of factors you want to consider, like the commute, whether you know the area, whether you want to even live there, the industry. I mean, there's so many variables, and these are really big sums of money that we're talking about, right? This isn't like a chocolate bar. We're talking, tens of thousands of dollars in transaction costs if you make the wrong move, right? So you want to make sure you kind of at least analyze all the bases a little bit.
And it's more than just the cost too. I mean, I guess you're taking risk as well. You buy a house somewhere and you don't like it and you want to get out. Now you have to hope that the market supports you getting that money back, right?
Yeah.
It doesn't take for us to go back very far in history to find a time when houses plummeted in price.
Exactly. I mean, that could have been catastrophic for sure.
I can go back in time about a year ago where I paid $10,000 to sell my house. So,
Yeah, I mean that's awful. We bought our house at the height of the market back in 2006, 2007, our last house, and when we moved out of that house 2 years ago, I mean we had lost probably $50,000 to $60,000 on the
Wow.
house.
Yeah.
Oh,
Thankfully, we had put 20% down, and we didn't end up having to pay anything to sell the house. But still, that hurts. That's
For sure.
$50,000 down the tubes. So thankfully, we were in a situation where we didn't end up having to pay a ton of money to get out of that house. But either way, it hurts. So that is something to consider too when you're buying a house. Is what is the market like? Is real estate overpriced right now? And if it is, maybe you want to sit back and rent.
well, I think though, Peter, your story kind of illustrates something about maybe why maybe you don't want to try and pay off your mortgage early or put down a huge down payment, because in the end, you probably ended up losing more. I mean, you were out that money. All of that money you put down, you lost. And, you probably end up actually losing more because you put down a bigger down payment than you would have lost if you hadn't.
Well, I think in some cases, though, it could have made it easier for him to
Well, it
sell
probably
the
made it.
home, too.
It made it easier for us to sell.
Yeah, that was the big thing for us. It made it easier for us to sell when we had a good opportunity to move. But either way.
Yeah, but I just think it speaks to the point that when you get a primary residence, you can't run around thinking, oh, well, this is a financial investment that I'm going to end up, coming out ahead. Can you tell I'm bitter?
Well, there's more financial cost than just
oh yeah
what your mortgage is and what your taxes are. There's the cost of what are you going to do if you want to get out. So you really have to know that you're in an area that you love and that you want to stay there. And it's hard for anybody, I think, to say 100% that they're going to buy a home and never want to leave it. But once you've signed that mortgage paper, it makes it that much difficult to get out.
What you guys don't understand is that Cornell was dealing with the Canadian housing market, which only goes up. We're told that repeatedly, that the Canadian housing market only goes up and that it will go up forever. So that when we look at our net worth statistics and feel great about ourselves, you have to factor that in.
Hey, you know what? We were told the same thing, and then eventually it wasn't the case anymore.
Oh, but that won't happen in Canada, I'm sure.
We were happening in Canada. We're told every day that because our banks are good, that we won't overexpose ourselves to housing.
I'm sure that Edmonton will never.
That sounds like a similar story from what the lower 49 have been told as well.
Our housing prices are all completely based on the price of oil here, so it's as the price stays low, there could be a bubble that could burst.
Yeah, it's pretty scary over there right now, and out in the West, yeah, for sure.
But yeah, I mean, I don't know. My big thing is I don't know that I'd want to pay off a mortgage early. Well, and when I had a mortgage, I wasn't planning on paying it off really early. I mean, I switched to bi-weekly payments, but that was about the only concession I'd make to paying off my mortgage early because the interest rate was so low. And instead of paying it off early, I could take that money and invest it
Right.
for the long haul and get a greater return. When you're paying off your mortgage, they say, oh, well, when you pay off debt, that's a guaranteed return of whatever. Oh, great, a guaranteed return of 3.9%. Good for me. So I would rather put that money toward investing and everything. So because that's not my priority. For somebody, I guess, who is really interested in being completely debt-free and doesn't want that obligation hanging over them, I can see them paying it off. And so I really think it depends on what you're comfortable with, too,
Sure.
whether or not you're going to charge forward and pay that off early.
And
Yeah.
what's your motivation? Why do you want to pay off that home? Why do you feel like you need to? And then looking at what the options are as to what you're doing.
Yeah, for sure. And I mean, I know, Miranda, you and I have talked about this before too. And that, I mean, if I was to do it all over again, I actually would have invested more as opposed like the money that I put in to pay off the house quicker. I actually, in retrospect, would have invested it instead. Knowing what I know now, knowing about my risk tolerance, knowing about how the markets work and how to invest, I would have actually done that, and I would have been further ahead in terms of my net worth. But that's just me, right? That's kind of based on my sort of knowledge and risk tolerance and personality and all that. But that's not the right choice for everyone. Like basically, the paying off your mortgage quicker route is sort of the safer route. You get the peace of mind, right? It gives you more security. Like once your mortgage is paid off, if something was, like let's say right now something was to happen to me, I know my wife and my daughter would be in a lot better shape than if I had a mortgage, right? Because they wouldn't have this debt over them, right? They basically have this house free and clear. They would be in a better position. So there's advantages, right? But so there's that safety security piece, but then but I pay for it, right? Because I could have instead invested that money and earned a significantly higher return, most likely. Well, in my case, I would have earned a lot more because, this was like, 2008 up further where, the market started really, really climbing, during the recovery. And so, I would have been way further ahead if I actually invested as opposed, maxed out my TFSA, maxed out the RSP, which is like your Roth IRA and your 401k. If I did that, would have been much further ahead. But
that's all conditional types of things. You made the best decision that you could make back then.
At the time, yeah,
right?
yeah.
I think all of us, if any of us said, you know what, it's 2008, do you want to invest more? I think we'd all say, like here's the bottom. I'm gonna put a whole lot more in.
Yeah.
I would have done that also in '99, 2000 when all the tech stuff collapsed. But we can't always do that, and we can't always know that we would have made the best decisions back then had we switched.
That's true. Yeah, like hindsight's 20/20, right? So, like at the time when I set this goal that we're gonna pay it off, there were a few things happening, right? Like when I graduated and had the first job, this was around that 2008 period, right? So, here's this kid fresh out of university, he's in his first job, and he sees his boss and his boss's boss freaking out because they just lost tens or hundreds of thousands of dollars in the markets because of the crash, right? So, you get exposed to that and you think, oh wow, this is really, really scary. They're losing a lot of money. This whole investing thing is pretty frightening. And unfortunately, I went to business school and we still don't, I don't remember learning about index investing even in business school, right? So, I didn't know how these things really worked yet, even though I studied business in university. And so that kind of had an impact, right? And then at the same time, I was also really into real estate investing as well. So I was already reading a lot about it. I wanted to invest in property, and I did end up doing that. I own a rental property right now too. And so that was kind of the other thing was, okay, well, I can pay off my mortgage and then I can take equity out of that house and use it to buy my first rental property. So that was also kind of part of my strategy as well, was to sort of specialize more so in real estate investing as well. So there was a few things that kind of, those things I would say that contributed to me saying, you know what, this investing thing sounds really scary. And at that point, I didn't know much about it, right? I didn't know how it all worked and how the markets work. And so I'm just going to focus on real estate. And so kind of, it worked out well. But yeah, like in hindsight, I'm kind of, oh, well, I just wish I, invested heavily at the bottom and then things would have been great. But,
although to be fair, you could have just as easily been scared off and just made bad decisions by trying to sell at the wrong times.
Right. And that's true. Yeah, there's that too. Exactly.
So just real quick. So you mentioned using the equity to get a rental property. So do you have a mortgage again? Did you borrow against your equity to get this investment property?
Yeah. Well, So what we have right now is basically, so we paid off our house, and then we ended up renting out that house. So right now it's fully rented. And then we bought another house, which is now our primary residence. So right now, in this present moment, we have one house that's mortgage free, and we have one house that does have a mortgage. So basically, the rental property pays for its own operation as well as the mortgage on our primary residence. So basically, the rental is paying our mortgage is what's happening right now.
Kind of pays for itself, in other words.
Yeah. And so right now we're actually not even using the home equity line of credit at all. I kind of wanted to have it there, to aggressively invest in real estate. But then I kind of got a bit scared off of having too many rental properties because you're not that very diversified, right? That's kind of the thing. Like right now, okay, I already own two homes, right? So that my exposure right now to the Canadian real estate market is huge, right? So do I really want to buy more property? I mean, from a
Yes, 'cause it
diversification.
always goes up.
Kyle, I keep
Canada's a
forgetting
big
this
place. You
golden
can buy all
rule.
over.
Devil on his shoulder.
I keep forgetting that golden rule. Yeah. So that's kind of the thing, right? So now I actually don't use that I have that home equity line of credit there, but I haven't used it really ever. And I just now invest very, very heavily in ETFs, broad market indexes, just to get some exposure to that, as opposed to being just fully in real estate. Because that's the other danger of if you're spending all your money investing in paying off your mortgage, you're really undiversified at that point. If the market crashes, you're done. If something happens in that neighborhood, you could be in really, really bad shape. And then the other negative thing too is that now, like right now, when we were paying out the mortgage, that's great. But then when we're done, I felt like I was behind on my retirement savings, right? So my RRSP or, my Roth or 401k wasn't as high as it should be, I felt. So now all that money that I used to put into paying off the mortgage is now going into investing into basically index funds or I buy ETFs. So that's basically where everything's going. So now I'm playing a little catch up. But you're able to catch up still pretty quickly because now you have all this money that you're no longer paying for the mortgage. So you're able to pump all that into indexes.
So let's go back a little earlier where you were saying how you were cutting costs. So you were using Mint, and there's a ton of programs out there these days, Personal Capital, QuickBooks, Quicken rather, to track your money. So you were actually doing, among other things, the rare thing of looking for places to save your money and actually saving it and doing something with it.
Right. So with Mint, I use it like the main kind of thing that I use it for is, well, one, I like it like just to make sure that there aren't any sort of unauthorized transactions, just from an audit perspective, because I can see where everything's going. I can quickly see if maybe someone stole my credit card or whatever. So that's the one thing. But the other thing I use it for is you can set these budgets really easily, where you say I don't want to spend more than X amount for restaurants or whatever, and it will warn me if I do that. So that's kind of one of the main reasons I use it for as well, is just to flag things that I should care about. If something is sort of deviating from where I want it to be. So that's really what kind of I use it for. But then in terms of, how do I aggressively save the money and then so that we can invest right now a lot into ETFs and before to investing in the mortgage. Well, like to do that, do you want me to take you sort of through the strategy that I did there? Because it worked out pretty well for us.
Yeah, if you don't mind
Sure.
telling us.
So what my wife and I did during our accelerated mortgage paydown phase was basically we said that okay, with her salary, her whole salary or almost her entire salary was to go towards day-to-day expenses. So the original mortgage, the monthly mortgage payment she would take care of, the groceries, all these day-to-day things she would take care of, and then we would set aside a certain percentage of her pay that she could spend on whatever she wants. So it was an amount that we both agreed to. And so this way, she can go and buy shoes and I wouldn't come back. And when she comes back, I wouldn't get mad at her saying, oh, come on, you already have 20 pairs of shoes. Why did you get this other one, right? So this way it kind of prevents marital conflict too. And she still has some spending money. And then on my end, I kind of did the same thing, except all my money went towards paying down the mortgage quicker. And now it's going towards buying basically index funds. So basically, I'll take something like 95% of my income and I would invest it into, back then it wasn't the mortgage and now it's into ETFs, right? And so that 5%, that difference is basically my own sort of play money, right? So that I can go and I can buy, something that I kind of still have my own spending money, right? So this way, both of my wife and I have kind of a good system where we each have our money. We never fight about money because I can't complain to her if she buys shoes. She can't complain to me if I buy, I go mountain biking. So if I buy something for the bike, everything kind of works out well that way. And because we kind of set this aggressive goal, it works out really, really well and it helps us do it, right? So my goal is, I should be putting in 95% of my salary towards index funds every month. That's what I should be doing, right? And so kind of setting those really, really aggressive goals is what really helped us pay off the mortgage earlier, and now it's helping us really aggressively invest and really, get caught up in terms of retirement savings.
Right, and it helps though too that you're both working full time, right?
Yeah. Yeah.
So you have 2 full-time incomes.
Yeah, that really helps. Really helps. For sure. For sure.
And it sounds like, I mean, what's nice is that you weren't already living up your lifestyle to eat up 2 full-time incomes.
Right.
I think a lot of people, if they have 2 people working, then they might be doing it so they can get by.
Mm-hmm.
Whereas you had a nice luxury where you were able to say, no, we're going to set up our priorities so that one of these paychecks is actually going to go towards this, and then we're going to use a portion of this one for that.
Exactly, yeah. I mean, we got kind of scientific about it. Like we would track our expenses over a certain period of time in Mint. We would see, okay, so typically on groceries, this is how much we spend. Typically on car, on fuel and all that, this is how much we spend. And so that gave us a really good idea as to, okay, how much do we actually need, and is her salary enough to cover these things, right? And so that was and so we, when we set that goal, and every time that if we ever deviated from that goal, I would go back and say, okay, why did we deviate? What happened? Is it because our car broke down and so I couldn't put as much down towards the mortgage or towards paying off the mortgage because we had to get the car repaired, or did something else happen, like we just went out to eat way too much, right? So, so that kind of tracking really, really helped, and it helped us stick to the goal. Because if you don't have that goal, I mean, goal setting and all that, everyone talks about it, right? It's almost like this cliche these days, but it's so critical, because without it, the money would just go. Like you wouldn't even really, it'd be gone before you know it. So setting that goal and then setting out Mint to have these automated systems to warn you when things are falling off the tracks was really, really helpful.
Well, it sounds like a big difference between what you do and what probably most people end up getting lost in is it's not so much that you had the goal, but that you had the action to actually go through with everything that you wanted in your goal.
Yeah. Yeah. So it worked out really, really well. And now we're doing it, by investing heavily into indexes, and it's working out well. So yeah, so it's good.
So, I mean, I know that what you've done, it certainly sounds unique, especially with the fact that you were able to use a whole paycheck to pay for things, as well as get rental property. Do you think what you did in paying off your mortgage early, is that something that's achievable for most people?
I think it depends on a few factors, right? Like the fact that we were dual income, for example, really helps, right? The fact that we're not living in Manhattan helps, right? So there are certain variables that help, right? Like in our case, the common argument is, oh well, I live in Toronto. There's no way I could buy a house there and pay it off in 6 years. That's just ridiculous, right? So then kind of my comeback to that is, okay, well, no one's forcing you to buy a house there, right? Maybe you should be renting. And you're in Toronto, so hopefully you're earning a much higher salary than I am, right? Because you're in this area with all these other jobs, right? And hopefully that higher salary offsets the higher cost of living in Toronto. If it doesn't, well, then are you sure you should be living in Toronto? Maybe you should be moving to another, this same goes like, living in Manhattan versus not, right? Should you be doing that, right? Like if you're a waitress earning minimum wage, working in Manhattan, right? And you're dealing with all this high cost of living in Manhattan, is that the best choice for you? Maybe you should, if you can earn that same amount working in another city where the cost of living is a small, tiny fraction of what you'd be paying in New York, maybe you should consider doing that. And I know there's different things, like maybe you have kids or a family, there's all these different variables, but that's something to, I think you have to consider that and try to kind of, like if you're living in this high cost area, you should have a higher salary, I think, to justify that. And if you don't, then are you sure you're living in the right city, basically?
Yeah, that's definitely a way to look at it, as well as, are you getting out of the lifestyle what you think it's worth? Mm-hmm. What you're paying into it. So a lot of people will live in a more expensive town. Like you said yourself, you might move somewhere closer, just because of the commute. I mean, that's right. And that's a huge thing. That's not something that you would just throw away. I mean, if you spent an hour each way in traffic, that's 2 hours of your life every day.
Right.
So that is worth money to you or to anybody else. And you can certainly be productive in other ways. So that does have a value, but does that value match what you're actually paying.
Mm-hmm.
And for a lot of people, maybe where they live, it doesn't match.
Mm-hmm. Exactly. Yeah, you have to take a really hard look at it, and so it's easier for some people than others, right? Like in our case, we we didn't live in downtown Toronto, right? We lived kind of in the Toronto area, but outside of Toronto, right? So yeah, you just kind of have to analyze it and see sort of what works best for you. So yeah, I mean, I think it's possible to replicate what we did, but there are certain variables that will make it much harder or much easier, depending on where you are, right? Like there are some really good high-paying jobs outside of Toronto where the real estate is a lot cheaper as well, and the cost of living is a lot cheaper. So so I think that's kind of my comeback to that sort of common argument is, well, I live in Toronto, there's no way that I could ever do this. If you are, hopefully you're making a lot more, and if you're not, then why aren't you living somewhere else where you can make that amount? So, anyways, that's kind of my 2 cents on the subject.
We're talking too about completely paying off your mortgage if that's possible, but for a lot of people, maybe that's not something they even want to do, but maybe they do want to pay extra.
Mm-hmm.
Sometimes you can even small amounts paid extra on your mortgage can add up over time. I ran some calculations on one of these mortgage loan payoff calculators just to see the current mortgage that we have, 28 more years on the mortgage. Even if we just added $50 a month, just rounding up our payment from $1,250 to $1,300 a month. Just by doing that, we would cut almost 2 years off the mortgage, and
Nice.
It would save us $12,500 in interest. So even small amounts can add up quickly over the long term. So maybe you're not going to pay off your entire mortgage, but maybe you want to add a little bit to your mortgage every month, or maybe if you get a tax refund or other windfalls here and there, you can add those to your mortgage as well, and just say, hey, if we ever run into a little bit extra money, maybe we'll throw that towards our mortgage. Otherwise, we're going to be investing or doing whatever.
Sorry, go ahead, Miranda.
I was just going to say, just kind of along with what Peter said, doing the biweekly payments is one really easy way to get an extra mortgage payment in each year. I mean, you can knock off not quite 3 years, but almost 3 years off your mortgage just by doing biweekly payments, and that can be a pretty decent size savings in interest as well.
Mm-hmm.
And it's hard to look towards the future like that when you're talking 25 years down the line. But you knock off 3, 4, 5 years as you're approaching retirement age. Not having that money paying towards a house is huge.
Mm-hmm.
That extra income in it, and you really don't know what your job situation is going to be when you're at that age either. So having that income freed up for the low cost of just a few extra dollars, sound like a salesman now. For just a few extra dollars today, it'll save you so much money later on. But it will.
Yeah.
You're setting yourself up for a nice place. But that's the thing too. So now, a lot of people, let's say we can get our finances in order. We can look through things. We can find the holes, and we could actually take action on those holes and put that money towards something else. We could save that money, and not save it like, I saved on buying a TV. I saved $50, but really you just, you got it for less money, but you didn't save anything.
Exactly. And that's a common thing, right? Is that perception of, I got these jeans on sale. I saved $20 because they were on sale. And then it's like, well, hold on. You already have 20 pairs of jeans.
Right. And you still spent $30 to get them.
Exactly. Right.
Still in the hole, the $30. Yeah, and it's a hard, a lot of people don't quite get that.
Yeah.
But do you think most people should have a goal of paying off a mortgage early? I mean, we've talked about a couple of ways in which you could just pay off a little bit and get a few years on the end. But, we touched on it earlier. Is that even something that most people should look into?
Mm-hmm.
Like, what situations is it better to start thinking about paying off your mortgage early versus, I'm better off trying to invest this in other ways?
Really, I think it comes down to how important it is for you to be completely debt-free and how you feel about that. Because, personally, I don't mind certain types of debt and keeping it if it's got a low interest rate. And in the case of a mortgage here in the U.S., I know this isn't the case in Canada, but here in the U.S., the mortgage interest is tax deductible. And it's not going to offset the interest cost, and it's not going to help you break even, but at the same time, it does kind of reduce the cost a little bit. And once again, it's just one more way to make your investments and other things that are going to provide you with a greater return more efficient. And, I feel the same way about student loans. I have student loans, and I am in no hurry to pay them off because I have a 1.9% interest rate on them. So
What for you?
why?
What for you is that tipping point? So, I mean, and this is going to be different for everyone.
Right,
because
yeah.
Everyone has different risk. But like for yourself, what do you think is that point where you go, all right, you know what, I'm better off paying this off now, or you know what, I'd rather just try to look for a better return investing.
Right. So I think when you start getting into the 5 to 6% range, the 6% annual rate range, that's when I start saying, well, maybe I'll start paying it off a little bit more. Because then it's harder to overcome that because I'm a very conservative investor. And people are like, oh, well, you're indexing, and so you should count on a 10% annualized return for the next 30 years. You should count on that. And I don't. I basically figure all of my investing for like my retirement and everything. I pretend like I'm going to get a 6% annualized return, and that's how I figure it. So really, really conservative thoughts on it, really kind of pessimistic, I guess, about it. So once I hit that 6% level, that's when that is my personal tipping point, when I start saying, yeah, I don't know.
But part of the safety net of that is by the time you make that decision, it's almost too late. Like if you've hit that point and you still have 20 years left on your mortgage, you're kind of stuck there. Like, yeah, you can work at paying it off, but you're getting that higher interest rate, and you're still stuck with that huge mortgage, especially here in Canada, where we do have to kind of, if we lock in for 5 years at a rate, 5 years later we have to have that discussion again. And if the percent's gone up quite a bit and you still owe a lot on your mortgage,
that's the beauty.
At that point, you're kind of stuck to that.
Right. So there's a big difference between the system in Canada and here in the U.S. Whereas here, if it just happens to be that you time it right and you got a mortgage at the right time, you could lock in a low rate for 30 years, and then it changes maybe that whole equation as to whether or not you're going to pay it off. Whereas you could get stuck on the other side too, where you could lock in a mortgage that has a very high rate, and maybe for a long time it doesn't pay to even refinance it for a while.
Yeah, because that's what refinancing it for.
But I mean, as rates start to go up, refinancing starts to not be as easy a thing to do.
Right, but I just think that right now, when you're in a low rate environment, now is the time to start looking into, well, how can I leverage what I've got? and I mean, it's why I got a 5-year loan on my car at a 1.9% interest rate, and why, even though it's a depreciating liability and not something that is even tax deductible interest, it's a 1.9% interest rate. I am not paying off my car early. I'm a bad personal finance writer, but it's just the way it is. I am not paying off my car early because it's such a low interest rate, and I've leveraged. I want this car. I'm happy with my car, and I've leveraged the lifestyle, and all of the money I would have put toward paying off that early goes toward investing.
Well, see, and that's the difference too, because like what we were talking about with Cornell is the difference there is the action that you're doing.
Right.
So I think for a lot of people, they get that 5-year car loan for the low monthly payment, so that they can afford that car now. And that's why they stretch it out. But there's no savings going into it. They just don't have to pay as much.
Right.
So it's not like, well, I could pay $500 or I could pay $200. What am I going to do with that $300 instead? Whereas I think for a lot of people, it's, well, I could pay $500, but I can't afford that. But I could get the same car maybe for $200, and I'll just get by, and it'll take me 5 years to pay it off.
Right.
And it's both leveraging, but with a different intent. And I think that's a big difference for a lot of people.
Yeah, and so I mean, I just think it depends on your system and what you're comfortable with. And Peter's just looking at me horrified at the fact that I'm going, yes, debt. Use debt to
We know you love debt, man. We know that.
Your lifestyle.
It comes down to a calculation, really. I mean, you have to sit down, you have to figure out what's important to you. if you're going to pay off a mortgage early, maybe you value the less risk and more peace of mind, maybe the more freedom of having a paid off mortgage. And, maybe you think that limiting debt's a sure thing. So those things are important to you.
Right.
On the other hand, maybe if you don't want to pay it off early, you're not doing it because you want to have your assets be a little more liquid and be more flexible and have those assets available to do other things with, like invest or whatever the case may be. And maybe you're going to see those higher returns by investing. So you really do have to sit down and have that calculation in your head and think about what's important to you and which way you're going to go. Because, for me, I'm kind of a little of both. I like to, first I make sure I'm investing, 20% towards retirement or more, and then saving for my son's education. And then after that, I start putting a little bit extra towards the mortgage as well. So I like to do a little of all of the above.
Yeah, and if I make sure I've got the retirement and my son's education, and then I'm like, nah, I'm just gonna spend it. We're completely different beings.
I was just going to defend that whole idea of leverage and compare it to something else, and then you just go and say something like that. I can't even tell you.
I'm so sorry. No, actually, I'm not. No, I'm not sorry. I like my life.
You talk about leverage, and there's leverage, and then there's leverage, right? There's you have a car loan, you have a mortgage, and then there's I have the mortgage, and then I'm going to take another loan on top of that and try to do something that might be risky with that. So, there's different levels of it too. So, the thing with personal finance is that personal part of it. We could try to think rationally, but a lot of the decisions really come down to us, and we have to try to figure out what's best for us. And it's not always going to be the same thing, right? We have 5 of us here, left over 6 of us, and we're all going to have slightly different answers as to what we should do. But it's great. It is still inspiring to know that you could set up your finances in a way that you could pour enough money into your mortgage to pay it off early.
Sure. And you can use the same strategies to do other things too, right? Like there are some people that I interviewed on my show that, one guy retired at 32 and he still has a mortgage. But what he did is instead of doing what I did where I paid off the mortgage, he put all that money into investing. And this was actually over that when, after 2008, he kind of invested heavily at the bottom. And so things have really went up since then. And now, that has allowed him to retire at such a very early age. So he kind of, he used the same sort of, he had these aggressive goals when it comes to saving a large percentage of his income, keeping his expenses low. And but instead of paying off the mortgage, he used it to invest, and things worked out really well for him. So it's the same. So these principles can really apply to either strategy, whether you want to get rid of debt and you want to pay off the mortgage ASAP, or whether you're more into investing and you feel comfortable with it and you're okay riding the ups and downs of the market, and then maybe that's a better path for you. So I think there's different ways of doing it, and then there's a big psychological piece too that I think, like in your earlier question, you mentioned kind of who should consider paying off their mortgage versus not. Like how do you decide whether it's right for you or not? Like one of the ways I would say is, if we have another 2008 happen and your portfolio drops 30-40%, are you going to be able to handle that and actually continue investing? Or are you just going to lose it and just sell everything and just swear off investing and never touch it again? And now you just completely decimated your entire nest egg, right? So what kind of person are you, right? Because I know some people who are highly emotional, and I know for sure, and I would never tell them, don't pay off your mortgage. You should just invest everything. Because you'll get a much higher return. So mathematically, that might make sense for a lot of people, and that's something that I would feel comfortable doing. Miranda's made it very clear that she would also feel comfortable doing that way, right? But there are some people that I just know that I would never advise that to, because they would start panicking, they would get anxiety, they might get health issues, and for sure they would panic sell. There's a huge chance that they would just say, okay, you know what? I've been ripped off. Someone talked me into investing. I shouldn't have done it in the first place. I'm just going to sell it at the very bottom, and I'm never going to touch it again. And they lost their entire retirement, but a huge portion of it. So right? So I think it really depends on the person too. Are you willing to learn how to invest properly? Are you willing to learn the best practices and pull it off? And are you emotionally able to handle it as well? Because some people just, they're just not wired that way. I don't know, but I think that's an important consideration, because we can talk about you should invest, definitely always invest, but then if someone can't handle it, I mean, that could be the worst decision of their life if they took that route.
Yeah, that's an important distinction. It's how you feel about it. Again, we go back to the personal part of it. What lets you sleep at night?
Yeah.
And be productive at the same time. And
yeah, if you're gonna have a heart attack in 10 years because you're always freaked out about having a mortgage, and you're riding the market just stresses you out to the extreme, and you can't get past that. Maybe that's not the right. Maybe you should look at other methods. Yeah.
So I think we've done a really great job of exploring the question of whether or not you should pay off your mortgage. And at least for me, I think it's certainly a personal question, but the fact of the matter is that it's out there and that you can have the choice to do it. And even if you didn't want to do that, you can still make the choice to do other things with the money also.
Right.
So there's always a way to do that. So that is really to me, that's the big takeaway of it all. But what I'd like to do is a final word. We'll go around and everybody else can give their summary of what they think about paying off their mortgage early. So we'll start with you, Tom.
We talked a lot about sort of whether you should be paying off your mortgage or investing, and Miranda brought up that it's not tax deductible here in Canada. I won't go into it too deep, but people in Canada can look into a Smith maneuver, which is kind of a fancy way of basically making your mortgage tax deductible. As you pay down your mortgage, you borrow back that equity and you invest it. So you're slowly turning it into what is a tax deductible loan in Canada, which is investing in stocks. So it is complicated. You'd have to look into it, but it's a way to kind of help with the tax situation with our mortgages, and also get you investing earlier while you're paying down your mortgage.
It's a very unique way to get you to put money into investing, right? It's not necessarily retirement investing. Is it just general investing?
General investing, no registered accounts. So it wouldn't be in your RSP. It's got to be a non-registered account.
Yes. I mean, I don't know if that would happen here or not, but it certainly sounds interesting.
Well, there's really no need for it to happen here.
Yeah, in the States, it would truly just be leveraged investing, period. There'd be no, that tax optimization wouldn't be there.
Yeah, I mean, unless you did something like do like a home equity loan and then invest the money in a like tax advantaged account or something, so that you would get the tax deduction for the interest on your home equity loan, and then you would get some sort of advantage for,
I guess technically,
Wait, now we're getting weird.
It sounds so much riskier here
It does.
than it does up there. And, Peter, what's your final word on paying off your mortgage early?
Well, my final word is just basically to sit down and think about those calculations, the opportunity cost of whether you're going to pay it off early. If you value that freedom of having a paid off house and being debt free and just having less risk and more peace of mind, or if you value more just being able to have liquid assets and being able to take advantage of opportunities that come your way and investing and so forth. So if you are going to be considering paying off your mortgage early, make sure you're getting all those non-mortgage debts paid off, those credit cards and other high-interest loans, and make sure you're saving. In my case, I want to make sure I'm saving for retirement still. Others may not do that, but I'm making sure I'm saving for retirement, saving for my kids' education, and after I'm done with that, I'm starting to throw money at the mortgage as well. Just make sure you're sitting down, thinking about your situation and what is the best for you.
And Miranda, what's your final word on paying off a mortgage early?
Yeah, I guess more of what Peter said. It's really about figuring out what's important to you and what is going to help your peace of mind and what your goals are and your preferred lifestyle. I mean, in my case, if I had things my way, I wouldn't even get a mortgage to begin with. I'd be renting. So.
And Cornell, what's your final word?
Sure. Yeah. So, I mean, ultimately, you're gonna get into that internal debate, whether you should invest in, or whether you should pay off your mortgage quicker, or whether you should invest. But One thing I think you should, even before all of that, is make sure that you're actually maximizing any sort of employer contributions out there. So if your employer matches your, like in the US, I guess it would be your 401k, and then in Canada it would be the RRSP matching, for example. Make sure to do that first, because if you're, I mean, let's say if they contribute, let's say 100% of what you contribute up to, let's say 4% of your income. I mean, that means if you put in $100, you're going to get $100. So you're getting 100% return on your money right there. I mean that's huge. That's basically free money. You're not going to get 100% return doing anything else, really. So definitely, and even if they're just doing 50%, well, you're still getting a 50% return. You're not going to get that investing in indexes or your mortgage, right? So definitely, make sure that you kind of take that off your checklist first before you start going in. Okay, let's start analyzing. Should I do quicker mortgage pay down versus doing the investing option?
Sounds good. Cornell, for our listeners out there, you mentioned your podcast. I mentioned your site. Tell us a little bit more about what you do online so that people can go out there and find you.
Sure, awesome. Yeah, so we actually had some really big news recently. Very recently, the podcast that I run became the #1 personal finance podcast in all of Canada. So I'm really excited. The name of the podcast?
Yeah.
Oh, Build Wealth Canada. The Build Wealth Canada podcast. Yeah, it's at buildwealthcanada.ca. And it's great. I mean, we have a lot of experts in personal finance on it. Experts in investing and personal finance in general, and also experts in entrepreneurship. So for anyone that wants to have a business on the side, earn some money on the side, we have experts from those different areas too. And it's great. And a lot of the experts, they've published their own books or they have their own courses. And we have a lot of giveaways on the podcast as well. So a lot of times the guests will also donate some books. I know Kyle has donated his. Miranda's been on as well. Thanks, Miranda, for donating your book as well. And we've had other guests donating courses too. So so it's great. So you can definitely go on there. You can get all the episodes for free. You can enter the giveaways to win free books, free courses from the experts. And it's buildwealthcanada.ca. But even if you're from the US, a lot of the information is transferable, especially when it comes to general personal finance knowledge. And if you want to earn money on the side. And even investing, right? There's a lot of overlap, with index investing, for example. So you can definitely learn a lot there, whether you're from the States or whether you're from another country as well. So that's buildwealthcanada.ca. Thanks for letting me plug.
Absolutely. I mean, we want all our guests who are experts in what they do. We want our people to go out there and find them and take part in their communities as well. So make sure you go do that. Make sure you go find buildwealthcanada.ca. So thank you again, Cornell, for joining us and sharing your story with us. And until next week, be good with your money.
Thanks for joining us on the Money Mastermind Show. Get more information at moneymastermindshow.com. Don't forget to subscribe to the show on iTunes and YouTube and follow us on Google+.